Hey, everybody. So on the screen here is chapter 13, problem number 1. You're about to watch is a video that explains how to walk through this problem along with a companion worksheet that I created for you. And here's what I want you to imagine. I want you to imagine that you're an intern or staff accountant. You've been asked to walk through a complicated set of facts that are new to you. And essentially the work paper, the spreadsheet that I'm providing is something that you're being given to kind of do your best to kind of sort through the facts using that spreadsheet as a template to walk through the logic that you need to walk through. And the idea here is that you're new to this topic as a student, but it would also be true that you'd be new as a new person, on an internship or on a full-time job if you were new to the group. And what you want to do is do your best to kind of sift through the information, follow the logic. You're going to learn some of the rules of bankruptcy from a high level, of course, by doing this problem and also problem number 2. Then problems number 3 and 4 are a little bit simpler than these first 2 problems, and they'll simply ask you to walk through some of the rules around what we talked through in class on Wednesday this week, which was sort of thinking through the order of creditors. Creditors with who are secured, creditors with priority, and creditors who are unsecured. So take a shot, use the videos as mini lectures, pause along the way. You'll see the on-screen tutorial with the spreadsheet that I'm providing as a help for the problem, and it's really meant to kind of mimic, like I said, an accounting role that you might have. Okay, keep in touch with questions. Thank you. Bye-bye.
Deals with the Walston company, which has to go through a Chapter 7 liquidation. I've set up a spreadsheet to help walk you through the process, okay? So my sort of focus here is less on you guys getting down to the right number, although I do want you to get to the right number, and more walking through the process and understanding these bankruptcy laws, okay? So what I'm doing is I'm providing you the solution I want you to take your time doing it. So we're going to walk through these together on the screen here. You do the same thing on your end. So the first thing to note is that we're given information about Walston Company. The company is going out of business, and we're given asset information and then liability information. So this is some balance sheet data. And the second thing to note is that for this company, we have assets that have a book value and a fair value. We have to kind of go back in time. Remember your Principles 1 detail around book value versus fair value. The book value is the value of these assets according to your accounting records, okay? In a bankruptcy, what happens though is we look at the books and we say, okay, this company's going out of business and the assets are not worth what's on the books. We have to go out and actually measure how much value is there in today? What's the current market value? So for instance, we might, count up all the cash. We would do a whole intensive review of accounts receivable. We would have an appraiser go out and appraise the land, and we'd also have an appraiser look at the buildings and equipment. I should note here, real world kind of connection point, this process of figuring out fair value could itself be a huge project, and one or more of you could help on one of these types of projects where as a staff accountant, you'd be part of this process of figuring out the true fair value. And it would require a lot of accounting, a lot of due diligence. So this problem is a very high level, kind of simplified view of the entire bankruptcy process within one problem in chapter 13. So for now, I want you to just imagine this big process playing out. And we have the ending values of 80,000 of current assets and book value, and then $35,000 of fair value. And just to give a little bit of color to this, imagine that we determined that the company had $10,000 of cash and then $70,000 of accounts receivable on its books. But then when we go and we actually analyze the quality of the accounts receivables, we find out, well, hey, those accounts receivables aren't really worth $70,000. They're only worth $25,000 because, and this might have to do with why the company's liquidating. It has customers that are also in distress and cannot pay back the accounts receivable. So that's why you might have a situation like $80,000 book value, $35,000 fair value. Okay, with that sort of frame in mind, let's now walk through step 1. What are the free assets here? Free assets, and what we're going to use that term, and we're going to actually build this into our computation below. What can we kind of sell immediately and get access to cash with? Okay, that's kind of the question. And the answer is that current assets typically are cash, accounts receivable, maybe inventory, things that you can sell pretty quickly. Can we immediately sell this land? And the answer is no, we can't. And here's why. Notice that we have a note payable down below in our liability section of the balance sheet, and it's secured by land. That means this land is not free. It's locked up with this note payable. So we're going to say no to the free asset for land. Buildings and equipment, we don't see any restriction there. So that's also going to be a free asset. Okay, so notice we have $235,000 market value or fair value for our current assets. So now let's shift to the liabilities portion of our balance sheet and take a look at that. The first thing to note, we're given a whole different, a range of liabilities, and we have information in the problem about the value of each. And then the laws help us understand who the creditors are behind these liabilities. And that's really important for you guys to understand is that in your text, when you read about bankruptcy, and I want you reading your text, you're going to see that the rules lay out that, for instance, liability secured with collateral, and in this case, the land is collateral, that is the top level creditor, a creditor who has the highest priority, and that's called a secured creditor. Okay, now remember, creditors are lenders. Creditors also have the first right of funding from the bankruptcy. So creditors are in front of line from even stockholders. Okay, creditors are kind of like the top priority when we're looking at bankruptcy and a company liquidating. And the top of the creditor list is going to be a creditor with security and collateral. The second grouping of creditors are going to be creditors with priority. That includes the federal government for income tax purposes. It includes employees who are owed salaries, and it includes the people like yourselves, maybe, who are going to be working on a bankruptcy, the accountants and the lawyers and other professionals. You're helping actually on the liquidation itself, and that requires administrative expense. The third class of creditors are unsecured creditors. Accounts payable is in this group. It's basically non-secured. There's no collateral there. And we know this about accounts payable and bonds payable. And we're going to see there's a portion of the note payable that is not secured. So this note payable is an interesting fact in here. Okay, if we kind of net down to total liabilities, notice that we have $309,000 of total liabilities, but only $235,000 of assets. And if you recall, assets equals liabilities plus owner's equity. We're going to go back to our Principles 1, Chapter 1 days, and notice we don't have enough assets to sell to kind of pay back all of our creditors in this liabilities bucket. And that's part of the process of what we're going to go through next. Okay, so how do the creditors get paid back? Well, the first thing we want to do is, and again, we're walking through rules right now. So have your textbook open while you're also doing this problem and listening to me. So the first thing we want to do is we're going to walk from left to right through with these secure creditors. So we know that we have a note payable secured by the land, and that note payable is $120,000. With the land fair value is up here, it's $90,000. So what's happening here is the creditor is, we're going to sell the land, and the creditor is going to get that $90,000. Okay, and that's going to be part of the note payable paid back. Now, if you notice, $30,000 of that note payable is still not paid back. So that's outstanding, and that's going to be part of this bucket right here. So we're going to come back to the rest of that note payable. So now that we've sold the land, now we want to look at the free assets that we can use for the remaining creditors. So I'm going to come back up here, and I'm going to pull in my current assets and my buildings and equipment, and I have $145,000 of free assets. So effectively, think about it this way. This is the stuff that we can go and just sell off, and we get $145,000 of cash with which to pay the next bucket or the next tier of creditors. So let's look at the next tier of creditors. We have administrative expenses for liquidation. We have salaries payable. We got our employees who we need to pay back. And we also have our income tax. The federal government wants its cut as well. Now notice one thing here. Notice how I am using Excel to reference the data above. So I want you to know too that if you were working in this space and doing a project like this, you would be using a spreadsheet in a similar way that I'm using it here. You'd have upfront facts, and then you'd want to be referencing back to the data. Okay, so I want you guys, this is also kind of like a spreadsheet building exercise as well in terms of your skill set. Okay, so I pay off my liabilities priority. I use my free assets to do so. So what we next want to do is we want to see how much in free assets do I have left over. So I take my $145,000 of free assets. I'm subtracting out here, and let me actually put in here just so it's super clear. Free assets minus the liabilities with priority give me $111,000 of remaining free assets. Okay. I still have unsecured liabilities to pay back. Let's see how much those are. Note payable secured by the land. Well, this is the unsecured portion. I'm going to go back up to that piece. This is the amount that the creditor did not receive because it was excess liability that wasn't secured by the land. So actually, I'm going to change this here and say portion not secured by land. That'll be a little bit clearer there. Okay, accounts payable. Let's see how much I've got. $85,000 of accounts payable. And then I have the bond payable. Again, accounts payable and bond payable, these are not secured. And that's the risk that a creditor takes when you don't have a security. And that word security, by the way, collateral is like a security blanket for the creditor. It's something that keeps the creditor safe in the event of something like this, a liquidation bankruptcy. So notice here, I have $111,000 of free assets. This is effectively what Walston has to pay back all of its creditors. But look at how much its creditors are due, $185,000. It's not going to have enough money when it sells this when it gets access to this $111,000 in cash. It's not going to have enough to pay back all of the creditors. So we have to figure out a process to fairly distribute funding to the remaining creditors. And here's what the bankruptcy laws say to do. You take your total free assets and you divide them into your remaining liabilities. And that gives you this ratio, what's called a collection rate, $111,000 divided by $185,000. By the way, I want to note, evaluate your formulas in here, okay? This is spreadsheet skills building. I want you to note that I've put some of these formulas in here just to make it a little bit easier for you guys to kind of step through this, the logic and also the spreadsheet math that we're using to represent the logic. Okay, so now let's figure out how do we do the final payoff. Well, the remaining unsecured liabilities, I'm going to come up here and simply grab these values. Okay, I've got them easily referenced here. Total down to my 185. So $185,000 here, $185,000 here. My collection rate is 60%. And here's how I go about doing this. Each creditor is going to be given 60% of what they're due, each unsecured creditor. And you're going to see that the math shakes out nice and neat. We're paying off $111,000 of unsecured creditors. That exhausts my remaining free assets. Everybody's paid off. These folks are a little unhappy because they're not getting their full amount back. This is the risk of lending. This is the risk of making a loan, of having accounts payable, of having bonds payable. This is why sometimes there's collateral involved. Because if you have collateral involved, you are guaranteed to get that funding back, as we saw up here. So this is why some loans and mortgages are a good example of this. The house is collateral, right? So this gives some insight into some of the kind of nuance with lending, the risk of being a creditor versus an owner. But also notice we've used up all of our assets. There is absolutely nothing left to give to the owners here. So the owners of this company, they are out high and dry. Tough luck. That's part of being an owner versus a creditor. And this is a good example of taking you through wing to wing, the bankruptcy process, and also a view of debt versus equity.